Deep Dive Amazon, AMZN, Full Valuation Case and Monte Carlo Simulation by Value and Momentum Portfolio. Institutional grade research on Amazon with catalysts to watch and actionable insights for investing.
Company overview.
Amazon.com, headquartered in Seattle, Washington, is a global leader in e-commerce and cloud computing. Founded in 1994, Amazon operates through three primary segments: North America, International, and Amazon Web Services, AWS. The company serves a wide range of customers, including consumers, sellers, developers, enterprises, content creators, advertisers, and employees. Amazon's retail operations involve selling consumer products and subscriptions through both online and physical stores, with a focus on price, selection, and convenience. The company also manufactures and sells electronic devices like Kindle, Fire tablets, and Echo, and produces media content. Amazon Prime, a subscription service, offers benefits such as fast shipping, streaming of movies and music, and other perks. AWS is a significant part of Amazon's operations, providing a broad set of technology services, including compute, storage, and artificial intelligence, to developers and enterprises. This segment has become a cornerstone of Amazon's business, offering services that support the rapid growth of cloud-based computing. Amazon also offers various programs that enable third-party sellers to sell products in its stores, enhancing its product offerings and increasing consumer choice. The company's advertising services, encompassing sponsored ads and video advertising, serve sellers, vendors, and other businesses.
Moat analysis.
Moat number 1, AWS wide and durable. First, let's talk about Amazon's crown jewel, AWS. This isn't just a business, it's a fortress. It's protected by 5 specific moats that make it incredibly difficult for competitors to catch up. The strongest thing AWS has going for it is how hard it is to leave. Once a company builds its entire tech system on AWS, they're essentially locked in. For a mid-sized company to move everything over to a competitor like Google or Microsoft, we're talking about a 2 to 5 year project that costs tens of millions of dollars. We can see the proof of this in the numbers. AWS has a $244 billion backlog. That is the largest in their history, up 40% from last year. These are signed multi-year contracts that prove customers aren't going anywhere. Massive scale, Amazon has a nearly 20-year head start in running data centers. They have the biggest global footprint in the industry. Just to give you an idea of their growth, in 2025 alone, they added 3.99 gigawatts of power capacity. That's more power than their entire infrastructure had back in 2022. On top of that, they make their own chips, like Graviton. This gives them a 30 to 40% price advantage. It's a simple cycle. Lower costs lead to lower prices, which brings in more customers, which gives them more scale to lower costs even further. The network effect. AWS has the biggest developer ecosystem in the world. Most developers learn AWS first. Most startups build on it first. When you have the most trained professionals using your tools, that's where the big enterprises want to be. It's a self-reinforcing loop. The more people who know how to use AWS, the more valuable AWS becomes. Breadth of services. Finally, there's the sheer variety. AWS offers over 300 different services. Most big companies don't just use one tool, they use 30 or 40. Now they're doubling down on AI with tools like Bedrock. By offering everything a business could possibly need in one place, they make it almost impossible for a customer to find a reason to look elsewhere. Moat number 2, advertising, wide but underappreciated. Moving on to the second pillar of Amazon's dominance, advertising. This is a business that brought in over $85 billion on an annualized basis, growing at 22% year over year at the end of 2025. It's a moat that most people don't notice, but it is incredibly hard to beat. The purchase intent data. Advantage. Amazon has something that Google and Meta can only dream of: transaction-level data. Google knows what you're curious about, and Meta knows what you like, but Amazon knows exactly what you actually buy. They know your brand loyalty, how much you're willing to pay, and how often you restock. Because of this, ads on Amazon convert at 3 to 5 times the rate of a Google search ad. When you're on Amazon, you're not just browsing, you're there with your credit card ready. Closed-loop measurement. For advertisers, this is the holy grail. In the past, you'd run an ad and hope it led to a sale. With Amazon, the loop is closed. Since they own the ad space and the checkout button, they can tell an advertiser exactly how many dollars were spent for every dollar of ad space bought. There's no guessing. They have the proof. Prime Video ads. Amazon has recently added a new layer to this moat with Prime Video. They now have about 315 million people watching ad-supported content globally. This really changes the game for advertisers because Amazon can now reach you at every single stage of your shopping journey. It starts at the top of the funnel, where you might see a commercial while you're just relaxing and watching a movie on Prime Video. Then it moves to the middle of the funnel when you actually go to Amazon to search for that specific product. Finally, they hit the bottom of the funnel by showing you a sponsored product ad at the exact moment right before you click Buy Now. It's a complete end-to-end ecosystem that very few competitors can match. Now, there is one potential threat on the horizon: shopping agents. These are AI assistants that could eventually do the shopping for you, potentially bypassing the ads altogether. However, Amazon is already building its own defense called Rufus. By creating their own AI shopping assistant, they're making sure that even if the way we shop changes, the transactions and the ads stay inside their ecosystem. Moat number 3, retail/fulfillment, narrow but scale protected. Finally, let's look at Amazon's third moat, retail and fulfillment. While this part of the business has thinner margins, it's protected by a level of scale that is almost impossible to replicate. Amazon has built the most sophisticated fulfillment network in the world, with over 1 million robots and more than $150 billion invested in logistics infrastructure. In 2025, they actually hit their fastest delivery speeds ever while simultaneously lowering their costs. They've seen a 70% increase in same-day deliveries year over year, and honestly, no other retailer can catch up to that without spending 15 to 20 years building their own infrastructure from scratch. This all feeds into the Prime flywheel. With over 150 million Prime members paying about $139 per year, Amazon has a locked-in audience that shops twice as often as everyone else. Once a household is used to that free one-day delivery, it becomes a behavioral habit that's hard to break. It's not just about the money. It's about the expectation of speed that competitors just can't match. What's really interesting is that Amazon doesn't even own most of what it sells anymore. About 61% of all units come from third-party sellers. Amazon essentially acts as a toll road operator, collecting fees for storage, shipping, and ads. These sellers are heavily invested in the platform because their reviews and rankings are tied to Amazon, making it very costly for them to leave. Now, it's not all perfect. Their grocery business is still in the early stages, and they are still a few years behind companies like Alibaba when it comes to quick commerce in Asia. Because retail margins are structurally low, usually between 4% and 9% in North America, this moat is really about being the king of logistics rather than having massive pricing power. It's a massive structural advantage, even if the profit margins remain a bit thin. Moat number 4, Prime/subscriptions, medium to wide. Finally, let's talk about the fourth moat, the Prime subscription. This is a massive part of the business, with an estimated 200 million subscribers worldwide generating about $44 billion in revenue. The real power here comes from two things: switching costs and the sheer value of the bundle. When you look at everything a Prime member gets, from free shipping and Prime Video to music, gaming, and even healthcare benefits in some markets, it's a classic bundling strategy. If a household tried to pay for all of those services individually, it would cost way more than the $139 per year they pay for Prime. This makes canceling the service feel almost irrational for most families, because the sum of all those parts is worth so much more than the price of the bundle. Because of this, churn is structurally very low. If you cancel Prime, you don't just lose one app. You lose a whole ecosystem of services all at once. Amazon is making this even stickier by pushing deeper into everyday essentials and groceries. We're seeing that customers who buy perishables through Prime shop twice as often, which locks them into the habit even further. On a durability scale, this moat sits at about a 7 out of 10. It's incredibly strong, but there is a slight risk at the margins. If the quality of their Prime Video content starts to slip, the overall value of the bundle could feel a bit more replaceable. Still, for now, it remains a very durable part of the Amazon fortress. Moat number 5, emerging, Kuiper, Zoox, pharmacy, devices, early/optionality. Finally, let's look at Amazon's emerging businesses, the pre-moats. These are high-potential projects like Kuiper, Zoox, and pharmacy that offer a lot of future upsides, even if they aren't the main profit drivers just yet. First, there's Project Kuiper, Amazon's satellite internet venture. They've launched about 180 satellites so far, with over 20 more scheduled for 2026. They are currently about 3 to 5 years behind SpaceX's Starlink, which has thousands of satellites in orbit. While some critics point to the slow pace, Kuiper could become a massive moat if it reaches scale, essentially becoming a global infrastructure for data. For now, think of it as a high-stakes call option. Then there's Zoox, their robo-taxi company. They are looking at a launch in Las Vegas in 2026, followed by LA in 2027. The robo-taxi market is still in its infancy, and Amazon is competing against established players like Waymo and Tesla. Like Kuiper, this is more about future potential than immediate dominance. We're also seeing real moves in Amazon Pharmacy. In March 2026, they launched a $299 per month offering for the GLP-1 Quick Pen, which is a big deal for weight management. This move shows they have the potential to seriously disrupt the traditional pharmacy industry by offering transparent, lower-cost options directly to consumers. Lastly, there are the devices like Alexa, Ring, and Echo. Amazon recently relaunched Alexa as a generative AI assistant. For non-Prime members, this is now a recurring revenue product at $19.99 per month, while Prime members get it as part of their bundle. It's a smart move to turn a household tool into a steady stream of income, though they still face stiff competition from Google and Apple. Overall, these projects show that while Amazon's core is solid, they are placing a lot of bets on the next decade of technology.
Moat erosion risks.
It's impossible to ignore the momentum building behind Google Cloud right now. While AWS is still the market leader, the numbers from the end of 2025 tell a striking story. Google Cloud grew at 48% year over year, while AWS grew at 24%. If that growth gap continues for the next few years, Google Cloud could realistically climb from its current $71 billion run rate to around $300 billion, putting it right on the heels of AWS. Google's resurgence is being driven by a few very specific advantages. First, they have the Gemini 3 AI integration, which is designed to be natively multimodal, meaning it handles text, images, and video all at once. To power that, they have their own custom TPU hardware, like the new Ironwood chips. These are purpose-built for AI and can be up to 30% cheaper to run than the standard industry hardware most others are using. Perhaps the biggest wildcard is Google's deepening partnership with Apple. Reports show that Apple is now using Google as its preferred cloud provider to power the next generation of Siri and Apple Intelligence. For a long time, Apple was one of AWS's biggest customers, so this shift represents potentially billions of dollars in workloads moving from Amazon to Google. Between aggressive pricing and a massive lead in AI infrastructure, Google is making a serious play for the crown. It's a clear reminder that in the tech world, no moat is deep enough to allow for complacency.
Price action and technical context.
Let's look at where the stock is trading right now. Amazon is currently sitting at about $212.65, which is roughly 18% below the all-time high of $258 we saw back in November 2025. It's been a bit of a bumpy ride lately. We saw a sharp drawdown in February 2026, where an earnings-driven sell-off knocked the price down from $246 all the way to around $197. Since then, the stock has been in recovery mode, consolidating and finding its footing in the $203 to $220 range over the last few weeks. As you're watching the charts, there are a few key levels to keep in mind. We have solid support between $196 to $200, which is that low area we hit in February. On the upside, there's some near-term resistance between $220 to $225 that the stock needs to break through. If it clears that, the next major ceiling to watch out for is $246.
Business performance.
The big takeaway here is that Amazon's efficiency play is actually working, and we can see that as their margins continue to expand compared to where they were in 2024. What's even more interesting for investors is how the valuation has shifted. The price-to-earnings ratio has derated significantly, dropping from a very high 61 times in early 2024 down to about 32 times today, which feels much more reasonable for a company of this size. However, there is a bit of a catch that's been causing some noise in the headlines. Free cash flow actually went negative during the first 3 quarters of 2025. This was largely due to a massive CapEx-heavy build-out for their AI infrastructure, though it did start to recover by the fourth quarter. To fund all of this AI growth, Amazon's total debt jumped to $65.6 billion in the last quarter of 2025. On top of that, they are currently raising a record bond offering of approximately $40 billion. So while the growth engine is humming, the company is taking on a material amount of debt to make sure they don't fall behind in the AI arms race. So what actually triggered that sharp sell-off in February 2026? It really came down to a rare miss on earnings per share. It was the first time Amazon missed its EPS target in at least 8 quarters. And even though it was a very narrow miss, investors had pushed expectations so high after the recent rally that any imperfection was going to cause a reaction. The interesting part is that if you look past that one headline number, the underlying business actually looked quite healthy. Revenue was still solid and even beat analyst expectations. When you zoom out, the overall earnings growth trajectory is still incredibly strong. In fact, their EPS has roughly doubled between the start of 2024 and the end of 2025. It seems like a classic case of the market hitting the pause button after a big run, rather than a sign that the fundamental story has changed.
Analyst coverage.
Looking at what the pros on Wall Street are thinking, the sentiment is still overwhelmingly positive, though it's tempered with a bit of a reality check. Since January 2026, we've seen 33 different analyst actions, and 32 of those are still buy ratings. There was only one downgrade to a hold from D.A. Davidson back on February 6th. However, after that fourth quarter earnings report, nearly everyone cut their price targets. For example, Morgan Stanley dropped theirs from $315 down to $300, and Evercore made a more aggressive cut from $335 down to $285. We saw similar moves from Wedbush, Piper Sandler, Oppenheimer, and Citi, with most of them landing in that $260 to $300 range. Even with those cuts, the median price target is sitting at roughly $295 to $300. When you compare that to the current price of about $213, Wall Street consensus is still implying there's about 40% upside from here. So, while the analysts are being more cautious and lowering their expectations for the short term, they clearly still believe there is a lot of room for the stock to run.
Insider activity.
When we look at what the executives are doing with their own shares, we're seeing a lot of selling, but it isn't a cause for alarm. The patterns suggest this is mostly planned and scheduled activity, likely through stock options or compensation plans that were set up well in advance. For instance, toward the end of February 2026, CEO Andy Jassy sold about $4.1 million worth of stock, and the head of AWS, Matt Garman, sold around $3.6 million. We also saw several senior VPs selling in the $1.5 to $2.2 million range around the same time. It's important to note that nothing here looks like panic selling. These are very standard structured transactions for executive pay. On the flip side, we aren't seeing any unusual large-scale buying from insiders either. It's essentially business as usual from an insider perspective, executives managing their personal portfolios rather than making a statement about the stock's immediate direction.
Valuation summary.
At its current price of $212.65, the stock looks fairly valued, or maybe even slightly cheap. It isn't necessarily a screaming bargain, But it's definitely not expensive either, especially when you look at it compared to its peers. If you look at the company based on its enterprise value relative to its earnings, it's actually the cheapest in the entire mega cap group by a pretty wide margin. In fact, if you just valued AWS in the advertising business on their own, they could justify the company's entire current value. That essentially means you're getting the retail business, the logistics, and all those future projects like Kuiper and Zoox for free. Plus, when you compare its growth-adjusted price to companies like Microsoft or Apple, Amazon looks much more attractive. The story here is really about margins. We've already seen them move from 18% to over 20%, and as AWS continues to scale, they could eventually reach the 25 to 28% range. The bull case for the stock depends almost entirely on whether that massive $150 billion in spending on AI and data centers actually translates into higher revenue. If it does, even a conservative valuation of $228 per share might be too low. The main risk to keep an eye on is that massive spending spree. If the hit to their free cash flow becomes a long-term problem rather than a temporary spike, it could weigh on the stock. There's also some political and regulatory noise around their partnership with Anthropic that could slow down their AI strategy. If it takes longer than expected for their cash flow to get back to normal, the stock might feel a bit expensive for a while. But for now, the fundamental growth story remains very much intact. Looking at the actual numbers behind our DCF valuation model for Amazon, we're starting with a base revenue of about $717 billion for the last 12 months. And it's important to remember that Amazon is sitting in a very strong net cash position of roughly $188 billion. In our base case scenario, which assumes the company grows its revenue at a 12% annual rate over the next 5 years and hits an operating margin of 20%, the math brings us to a fair value of about $228 per share. Compared to the current price of around $213, that suggests the stock is currently undervalued by about 7%. Now, if things go exceptionally well, the bull case, where growth hits 15% and margins climb to 23%, the stock could be worth as much as $344 per share. That would represent a massive 62% upside from where we are today. On the flip side, we have to consider the bear case. If growth slows down to 9% and margins get squeezed to 18%, the fair value drops to about $158 per share, which would be a 26% decline. Essentially, if you believe Amazon can maintain its double-digit growth and keep expanding those margins through AWS and advertising, the current price offers a very attractive entry point with significantly more room to run than to fall. To wrap up our valuation deep dive, let's look at the break-even analysis. Essentially, we're asking, at what price does this stock become an undeniable bargain across every single metric we use? The point where all our different frameworks start screaming undervalued at the same time is between $175 and $185. If the stock were to hit $180, its valuation becomes incredibly hard to ignore. At that level, its enterprise value relative to earnings would drop to 11.8 times, making it the cheapest mega-cap stock by a mile. Its price-to-earnings ratio would be around 25 times, which is actually below the S&P 500 average, a steal for a company growing its earnings at over 30% year over year.
Monte Carlo results.
To wrap up the technical side of our valuation, let's look at the results of our Monte Carlo simulation. This is essentially a way of stress testing the stock by running thousands of different scenarios based on various growth rates, profit margins, and spending levels. Based on these simulations, the expected value for Amazon stock comes out to approximately $263. If you compare that to the current price of $212, it suggests there's a potential upside of about 24%. However, the simulation also gives us a bit of a reality check. The current price sits right around the 45th percentile. In plain English, that means in about half of our simulated futures, the stock is worth more than it is today, but in the other half, it could be worth less. This tells us that while the odds are slightly in our favor, there isn't a massive margin of safety at today's price. When we look at the probabilities over the next 5 years, there's a 55% to 60% chance the stock will be higher than it is now. There's about a 30% chance it hits the $295 target that many analysts are calling for, and an 18% chance it drops below $160 if things really take a turn for the worse. The most interesting takeaway, though, is what we call asymmetry. The upside potential is much larger than the downside risk. If Amazon's massive AI investments in AWS really pay off, the gains could be 5 times larger than the potential losses in a worst-case scenario. So while there is definitely risk involved, the potential reward is much more significant, which is exactly the kind of setup many long-term investors look for.
What could change the thesis?
The AI spending gamble. The biggest risk right now is that the massive spending on AI simply doesn't pay off quickly enough. Amazon is planning to spend $200 billion on capital expenditures in 2026. If the demand for AI workloads doesn't fill that capacity, the hit to their cash flow could become a long-term problem rather than a temporary one. To put it in perspective, every 1% drop in AWS margins means a $1.4 billion hit to their annual income. The Anthropic political conflict. There's some real-time drama with Anthropic. The AI company Amazon has invested $8 billion in, following a recent executive order cutting federal use of Anthropic and a subsequent lawsuit against the Pentagon. There's a lot of political tension. Since Anthropic is a major driver of revenue for Amazon's AI platform, any escalation or new regulations could hurt both the value of that investment and the momentum of AWS. Physical infrastructure vulnerability. We recently saw a wake-up call with drone strikes on AWS facilities in the UAE and Bahrain earlier this March. Amazon confirmed some structural damage, and it's a reminder that global tensions can have a physical impact on the cloud. If enterprise customers start to lose trust in the resilience of AWS due to these kinds of regional risks, it could damage Amazon's reputation in a way that takes years to fix. This is a tail risk that the market hasn't really priced in yet. The AI infrastructure bubble. Some big names in finance are warning about a potential bubble in data center spending. There's about $662 billion in off-balance sheet leases across the major cloud players. If it takes until 2030 or beyond for AI to actually start making serious money, which is a very real possibility, the market might decide to re-rate all the big tech companies lower, including Amazon. Antitrust and regulation. Amazon is currently under the microscope with multiple antitrust investigations from the FTC, the EU, and California. If regulators decide to force a breakup or limit how Amazon bundles Prime, AWS, and advertising, it would be highly destructive. That cross-subsidy engine, where one part of the business helps fund the others, is a huge part of their secret sauce. Persistent negative cash flow. Finally, there's the concern about cash flow. With a $40 billion bond offering and $200 billion in planned spending, there's a real chance that free cash flow could stay negative or near zero for several years. If that happens, Amazon starts to look less like a high-flying tech giant and more like an over-leveraged infrastructure company, which would fundamentally change how investors value the stock.
What are the upside catalysts to watch?
When looking at what could drive the stock higher in the next few months, all eyes are on the upcoming Q1 2026 earnings report, currently expected on April 30th. This is the single most important event on the horizon for Amazon. The big question right now is whether all that massive spending on AI infrastructure is actually going to pay off. Investors are currently a bit skeptical, but one strong report from AWS could change that narrative instantly. If AWS can show growth of 26% or higher, combined with improving margins and a strong revenue forecast of $180 billion or more for the second quarter, it would be a major signal that the AI cycle is working. A result like that would likely clear the path for the stock to head back toward the $240 to $260 range.
Bottom line.
On the fundamental side, Amazon is in a strong position. While they had a minor earnings miss in the fourth quarter of 2025, breaking a 2-year streak of beats, the overall earnings trend is still growing fast. The big story, of course, is AI. Amazon is in the middle of a massive, aggressive investment cycle, with over $200 billion in capital expenditures planned for this year alone. It's not all smooth sailing, though. There are three major warning signs for investors. Free cash flow is expected to stay negative through the middle of the year, and debt is rising sharply to fund all that AI infrastructure. We recently saw a material hit to AWS facilities in the Middle East, which is a new and developing risk for their global cloud operations. The ongoing feud between the Pentagon and Anthropic, where Amazon has billions invested, is a significant political overhang that could impact their AI revenue. Despite these risks, Wall Street remains very bullish. Even though many analysts cut their price targets recently, those targets are still about 40% above where the stock is trading today. Technically, the stock is about 18% off its all-time highs and is currently consolidating. There is some near-term risk of a death cross on the charts, which just means the short-term trend is struggling to stay above the long-term average. According to our internal modeling, the stock currently presents a significant opportunity for appreciation. Our simulations indicate a probability-weighted fair value of approximately $263, which represents a potential upside of roughly 24% from current market prices. While the stock is attractive at its present valuation, it enters a definitive bargain range between $175 and $185. Furthermore, any price point below $160 would constitute an extreme discount relative to the company's intrinsic value. In short, there's about a 60% chance the stock will be higher 5 years from now. While the stock isn't cheap in a traditional sense, the setup is favorable. The potential payoff, if their AI strategy works at scale, is much larger than the potential downside from their current spending binge. The next major turning point will be the Q1 2026 earnings report on April 30th. The growth rate of AWS in that report will likely be the single most decisive factor for where the stock goes for the rest of the year. Thank you for your attention.
Disclaimer.
This report is prepared for informational purposes only and does not constitute investment advice, an offer to sell, or a solicitation of an offer to buy any security. I have no business relationship with any company mentioned in this post, nor do I hold any shares, options, or derivatives in them. I have no plans to initiate any positions within the next 72 hours. This article reflects my own independent research and opinions. I am not receiving compensation for it. Markets are unpredictable, and past performance does not guarantee future results. Please do your own research or consult a licensed financial advisor before making any investment decisions. Investing can be risky and may not be suitable for all investors. All data sourced from company filings, earnings calls, announcements, and publicly available analyst research as of March 12, 2026.